Welcome to This Week in Money. I'm Phil Mackesy. Today, Ross Clark with an up-close look at gold's big drop this week. Pamela Aden on the mining sector. Is there any hope here? And from December, John Kaiser talks about the juniors. We begin with Ross Clark right after this.
The best of the best. Randy Elvis Frisky and his Las Vegas show band. 40th Anniversary Aloha Tour. This April in Camrose, Edmonton, Red Deer, Drayton Valley, and Lloydminster. On sale now. Details at randyelvisfrisky.com. Welcome to This Week in Money, the source for market opinions. Here is Phil Mackesy.
Ross Clark with CIBC Wood Gundy, our guest today, as we check the ominous financial headlines together, Ross. From today's Wall Street Journal, gold sinks into bear territory. From Forbes, gold pounded below major psychological support at 1,500. Yesterday, you and I were talking. You sent me a note that said the interim downside target is 1,529. Does today's move surprise you at all?
Well, it was the 1529. Yes, it's more than I thought we would do initially. Clearly, I had been looking for us to bounce off. Now, we didn't talk last week, but the notes that we had sent out to clients was that the interim low that happened right around the first of the month is very common in gold. Typically, you find an initial low in the first 1 to 3 days after you take out the March low. We got a good bounce, but the key was going to be the 62% retracement of the March to April drop. So in this case, the retracement rally, the key level for resistance was going to be 1587 on a closing basis. So intraday, we got up to 1590 the early part of this week, couldn't close through the 1587 on that day. And then, you got Morgan Stanley coming along, taking their $200 profit after having been in the gold market for a year, 2 or 3.
Yeah.
So they get their $200 profit and say reverse from being long to being short. You've got Paulson, who's getting redemptions, and his big position is gold. So you've got a lot of pressure coming to bear on the market. And technically, from my perspective, the chances of us having moved through that resistance, that 62% on the first rally, was almost minimal. I had presented about a dozen or maybe more charts of examples in the recent work showing what to expect off that April low. About a third of them get up to the retracement level, back off, and then come through. And when they do, the move is exceptionally good. The targets were going to be in the 1660 or 1770 range. But in the years where you can't get through that retracement level, then you get a second wave of selling that's equal in magnitude to the first one. So in this case, on a closing basis, the decline had been about $61. So off the 1590 high that we put in early this week, it looks as though 1529 would be a minimum downside target. It could possibly exceed that. Well, possibly became the reality of life in the last few days.
After hours selling kicking in, gold trading around $1,475 at this point, down more than 5% on the day. Commodities generally getting whacked today.
Oh, across the board. Copper was up to $3.43 this morning. I think closed the day around $3.35. Still thinking there that actually we're working towards a 3 to 310 target as far as the copper price is concerned. Grain markets have been weak, just across the board. The biggest commodity of them all, the oil market, having another rough day, down $2.50 here as well. So the bears can say that, or the bulls on gold can say that there's been a raid, but in reality, it's been a raid across the board. And it's not so much because of strong U.S. dollar, because the dollar is stuck here at this 82.5 range. Got up over 83 a week or so ago, couldn't hold that, back down in support. It's really boxed in. And my view there in terms of the dollar index is that as long as it holds around the 82.20 level, that still has the chance for an upside breakout here. And that big long-term base we've talked about is still, I think, viable for now.
Roz, was today's movement just a fluke? I mean, apart from today's consumer sentiment and the retail sales figures, no really major news that would cause such a drop in the price.
No, I don't think so. If you might have, the other catalyst on the short term is the fact that the yen had a really good day, and gold has been moving up in terms of yen. There's the money that's been pouring out of Japan since they've announced the various measures here to increase the monetary base have had a positive effect for all of the what will I call it? The substantial markets, the safer markets in the world. So, if you take a look at the North American markets, what I would call sort of the bipolar, where companies with good solid balance sheets and dividends are going up and everything else is easing off, that money's been pouring into, quote, the things that are working, and they've really been getting a good kick. And the other thing that the Japanese money clearly has been doing is holding up the gold prices. Gold in the terms of yen was at an all-time high just the early part of this week. So with the yen reversing, that's another reason why the gold, or an excuse that everybody's going to make for gold taking it on the nose here today.
Russ Clark with CIBC Wood Gundy in Vancouver, our guest here on This Week in Money. And gold may be down, but the disconnect between the metals and the miners just seems to be growing. Listen to the bullion ETF here. GLD down 10%. Year to date, the SLV down 13%. But the gold stocks are getting killed. Here's the big three. Gold Corp off 18%. Newmont down 22%. Barrick down 34% year to date.
Yeah, well, you've got the majors out there saying that expansion for them has been something that has not been working the last few years. They've, all these big developments that have been going on, trying to bring things on stream, are going way over budget. You've budgets of $3 billion that are turning into $8 billion projects and more, and it's just at the point where they're saying enough is enough. And so it's hurting some of the companies. They're hurting the royalty companies who have put up some money and anticipated to have cash flow coming back. So the perception there has definitely been down. In the junior field, where they're constantly looking to raise money, there just isn't that type of cash sitting around. We saw that after PDAC in particular, that first Monday at PDAC.
Yeah.
Everybody's got a good story, but they're all asking for money. And that was one of the worst days that we saw for the miners relative to bullion. And, as the chart we've got here, of the three charts on that second page, the lower one just shows the action on a percentage basis for the GDX and the GDXJ. So you got your juniors against the seniors. And percentage-wise, they're tracking very similarly right now in the last year, but it's, the juniors are down dramatically from the 2011 high. But once again, it's because they had that great move on the upside.
GDX and the GDXJ both down year to date about 30%, and that's pretty much reflected with the indexes themselves, with the XAU and the Huey. They are also down 30% year to date.
Yeah, it's common across the board here right now. And as I've said, I think you really need to see gold to have put in a new plateau, a new floor, and then taken out the key resistance levels, and the big ones up there at that 1800 level that we've been up to 3 times subsequent to the 19.25 peak that was put in. It really needs to get through there, I think, before the miners are going to have sustained moves. If at each one of these interim lows, we're getting good bounces. You had a 30% run off the bottom last spring in most of the miners, but to much lower highs than they had previously been at. So at this point, the gold market's still got to prove itself. My thought is, and I know everything depends upon time frames that you're looking at.
Yes.
When I look at the run, and on that front chart where we've got the gold price showing a monthly chart, when I look at a market that's broken out of a base and had a move, you look at potential resistance support levels coming back in terms of either the retracements, and in gold, the key numbers would be at a 38% retracement, a 55%, not a 50, and a 62%. And also at the 50-month moving average and the 100-month averages. So the key level, and I would not be at all surprised that we see this tested next week, will be in the 14.25 to 14.50 range.
Wow.
The 14.25 is going to be down, testing close to the 50-month moving average. That's the same average that we tested during the worst of the market in 2008. And in both the corrections of 1975, 1976, that one, and also after the 1980 peak, that 50-month moving average was a pretty good level to bounce from. So I would think that that's what we want to have in the back of our minds here. But in terms of the upside, once you're in these interim downtrends, the key is resistance, and that's what I was trying to get across to people in the last couple of weeks. You have to take out one of these key resistance levels before you can have the confidence that we're going to get a sustained move.
I guess that brings my next question up. Is this the final washout, or is this just another leg lower? Where are we going from here?
Well, the key to me now is going to be mid-June. I've had a series of cycle windows for highs this year. The first was going to be that February 8th to 13th. We did a consolidation into that period and then broke hard as soon as we got to the end of it. The next one was going to be the last week of March, so we consolidated once again and had that crack. The next potential window for a high for me is the middle of June. So I'm assuming that this month we will put in some type of an interim low. You know, where is it?
Mm-hmm.
Is it at the 50-month average, or is it, back at the 100? Is it the 55% retracement, which is 1240? Too early to say. But clearly, with the volumes that we're seeing right now, we're bound to see a climactic turn here.
Yeah.
So it will be the bounce into mid-June that I will be looking for to see what type of recoveries we're looking at. If we just get back to retest the 1600 level and fail, that's going to be pretty rough.
If this kind of thing continues, are we going to see continuing divergence between bullion and the miners?
You probably will see that. I was looking to back to the 1976 bottom, the 1982 bottom, and likewise the 2008. Those are the big ones out here when we've had hard breaks. And you tend not to see a lot of divergence at the bottoms. You'll see a low being made simultaneously, stocks and bullion. And then within a week to 10 days, you'll get a retest, and it's that tested low that we want to be looking for to and see if the miners can hold in on the tested low. There tends not to be a divergence as much as they turn in sync from those levels.
Going to be interesting to watch. Ross Clark from CIBC Wood Gundy here on This Week in Money. Ross, how can we get a hold of you and get a copy of those charts?
The number here in Vancouver is 604-661-7759, or you can get me on the net at ross.clark@cibc.ca.
Ross, I appreciate you talking to us. I know it's been a crazy day for you. Take the weekend off.
I plan on sitting back and relaxing.
Thanks, Ross.
Thanks, Phil.
This Week in Money is archived online at talkdigitalnetwork.com.
The Aden Forecast is a monthly newsletter with, get this, a 30-year-plus track record. It is all about the 3 M's, markets, money, and metals. Pamela and Marianne Aden are also professional money managers. You can find out more at AdenForecast.com. Pamela Aden with us today. Pam, it's good to have you here on This Week in Money.
Oh, thank you for having me. It's a pleasure to be here.
You are at the World Money Show next week. It's here in Vancouver at the Convention Center. More info at moneyshow.com. What are you and your sister going to be doing up here?
Well, we're going, other than Vancouver's a lovely time of the year, of course, we look forward to speaking at the conference and being part of it.
What are you going to be talking about while you're here at the show?
Well, we're going to talk about, there's a lot to talk about because as you have seen in the markets how much they changed just entering this year since January to today, that 2013 has definitely had a change in tone in the markets in general. And so we'll be talking about that. And we're going to talk about why there's certain markets that we just stay with it. And we'll talk about why gold is still in the bull market, even though it looks like many people are starting to throw in the towel. So we'll be talking about that too, and how strong the stock market is and why. So there's several things. We're talking about the currency markets too.
We are going to cover some of those things this week in our interview, Pam. I want to start with the general overall markets. What's going on? Every day we are told that the global economy is either in recession or in recovery, just looking for direction. You'd think all this bad news that we're hearing from Europe, for example, would be bad for markets. We know that is not true. Here's the Dow and the S&P hitting record highs. What's the market telling us?
Well, that's what's so confusing. And I think that's why it's confusing for many people, because the global economy really isn't growing as well as the stock markets are telling us it is. And we always like to call this like a subsidized optimism is what we see in the stock markets, although you can't fight the Fed, in other words, or fight any of the central banks, because they're the ones that are keeping the momentum going, and it's certainly working. The stock market, once again, is reaching a record high, and a strong record high this week. So, we can't fight it. You go with it. We definitely go with what the trends are there. So we are invested in the stock market. We have been, and it's been good. It really started taking off and taking on its own character last December, into the new year. And that's when it really started taking off, and where we saw where it was moving in lockstep with most asset markets, like the gold market, the metals market, and the stock market were moving together after the financial crisis of 2008. But that started changing the end of last year, and we had a clear breakout of the movements. Now, gold took clearly a back seat while the stock market continued to soar. So, yes, this is all central bank pushing, we feel, but we, like I said, we don't fight the Fed. We go with it, and we'll be with it for as long as it lasts.
Pam, we in April always start to see the element of seasonality in the markets. Here's the latest over at Market Watch. Mark Hulbert, why it pays to sell in May. We're going to be hearing this for the next couple of weeks. Does it pay to sell in May? Is it going to be a good idea to sell in May this year?
Well, it sure looks like it is, because simply, if nothing else, it's just risen so much. In the first quarter and going into this month, we've had such a strong stock market, especially in the U.S., and so if nothing else, it's due for a downward correction, and May is right around the corner. So that sell in May is probably not a bad recommendation at all.
What about folks, Pam, looking for entry points into the market? Is this a good time to be thinking about that?
Well, it's always a little nerving to chase a market, and that's what it looks like you'd be doing if you bought today or tomorrow. If you're in, you would enjoy the ride. But if you're not in, I wouldn't necessarily buy right now. I would wait for some sort of weakness.
Pamela Aden from the Aden Forecast here on This Week in Money. Pam, we talked earlier about all that bad economic news. You would think that would be great for gold and silver, and again, here we would be on the wrong end of the equation. Goldman Sachs saying that it's time to short gold. They see gold falling to $1,300 by the end of the next year. And I'll quote here from Goldman Sachs: "Conviction in gold holdings is waning quickly." What's your take on that?
Yeah, it's especially the fall, that when we started the second quarter, this last push down in the gold market really turned a lot of people bearish, where now the word bear market has become a lot more in the vocabulary of many, and it's not surprising, because it's been a year and a half since it's been going sideways. But the point we see is, which is a very powerful point, we think, is that it's not declining, it's simply moving sideways. It's been holding at a very important bottom that it reached like a year ago, December, and every time it tests it, it doesn't break it, and that's the 1536 level on gold price. So we see a lot of strong hands buying at that level, and whether it be central banks, whether it be investors, whoever it may be, they are buying there. So that's a very critical level for us and the bull market, because there have been weakened signs on other indicators, but that's the bottom line. 1536. If it stays above that, the market is still in the strong hand area.
We've got another quote here from George Soros. He says the 12-year bull run for gold running out of steam, and we know that gold is almost in bear territory. We get a feeling that a major bottom is coming. Do you see some kind of a buying opportunity, Pam, in the next 6 to 12 months in gold?
I do, actually. If say, this is still an if the 1536, say 1530 level is clearly broken, like looking out this month, then you could see gold fall another $100, even probably $200. Say $1,300, $1,400 is a very realistic bottom side in the worst case scenario. And if it were to do that, I would clearly buy at that level. And if that were to happen, it would probably happen sometime this year. So yes, I would be looking at 2013 as buying in good weak moments during this time period.
Pam, it seems like silver and gold are behaving independently of each other so far this year. Silver down 9% since we started off. Hard to believe that it was only 2 years ago. Silver was $50 an ounce.
Exactly. It was exactly 2 years ago in April that it had reached that. But of course, that soared. That was an unrealistic move to begin with. It just really took off. But that kind of is a characteristic of silver. Once it takes off, it just soars. And especially if it has the resource sector and the precious metal sector behind it, then it soars. That's when it really goes wild. And so this fall of the last 2 years is really taking away the excess because it's staying above the $26 level, which is a key level, just like 1536 is for gold. So that's the number we're looking at for silver. It's in a very similar situation as gold is. We feel that the 26 level is very important to see if it holds. We're still in that critical juncture moment right now, so we're watching that very closely. But say like it was at the $8 to $10 level before it really took off to rise up to almost $50 back 2 years ago. So for it to come down to $30, $27, $30 level is still at a higher level base than it was when it started. So that's how we're looking at it, even though it's been 2 years.
Silver moving independently of gold, or is it moving in lockstep with gold, Pam?
It's been moving in lockstep with gold in recent months. Not always. It wasn't that way before, but it has been. And then, of course, the resource sector has been disappointing, too. And so that also weighs on the silver price. So silver has actually been weaker than gold over the last several months, but also we believe that's part of that excess, too, still unwinding.
Pamela Aden from the AdenForecast.com here on This Week in Money. And you'd think all this bad economic news would be terrific for gold and silver. We've already figured out why not. You'd think it'd be even better for the miners, but the story from the TSX Venture, quite different. It's off more than 25% since last April.
I guess the gold mining business has been terrible. Like, that's probably the worst sector in the market, clearly. And it is at bombed-out bargain levels, if we've ever seen it. It's like the worst fall we've seen since the financial crisis in 2008. But we're looking at, there's several selective buys, buying at these bargain basement prices and we don't think it's a bad idea to be picking up, not to load up, but pick up a few of these good levels.
Now, Pam, you go to a lot of these conferences, a lot of these resource-based conferences. What's the general mood that you're seeing? Has that changed at all? Is it beaten down like the mining sector is?
Not as beaten down, but it has come down. And if you look at the copper prices as the barometer for the resource sector, you can see it's been coming down a lot over the last couple of months. But it's not out again. Again, it's similar. No, but silver has been worse, but it's similar to silver. And we see that, yes, the resource sector in general, looking at the big companies like BHP Billiton and Xstrata and any of those, that are big companies, they have come down a lot. So they're in an interesting area, too. And we're looking at those closely to see when is a good time, probably coming up soon, to be buying that. But that's another interesting point about the resource sector. Why aren't they rising if the global economy is really on a recovery? Yeah. That's another separation there that isn't matching. And so that's why people are confused. Like, some of the markets that move together and they should move together are not moving together. So this has been kind of a really an unusual year so far.
Why the disconnect in sentiment?
We think it's really liquidity-based, even though that sounds like a broken record. I mean, they keep doing it. The major central banks of the world are just flooding the world with money, and now Japan added even more to it just this past couple of weeks. So it's Bank of Japan, and the yen has collapsed as a result. This Nikkei is way up and has soared, and the U.S. is doing the same with the Fed's ongoing quantitative easing. There's the Bank of England. There's the Euro Bank, central bank. They're all out to save the system. In other words, and with even if it means a little bit of inflation, but they're looking forward to not having too much inflation, and that's the big question really going forward. Will it be or won't it be? Will it? It seems to us that it's we don't know what the outcome. The verdict is still out as what the final outcome will be after all that liquidity gets through the system and how it's going to happen, how it's going to work out. That's really the big question today.
Pamela Aden from AdenForecast.com here on This Week in Money, wondering if we are here at the bottom, or could it get worse in the next little while? What do you see from where you stand?
Oh, the resource sector, yes. I think, if anything, it's not only when are you going to buy it, it's also clearly a barometer for the bottom line in the world economy. Like we saw that the imports in China has, as of yesterday, they came out and they had some good imports that helped the Australian dollar, which is a commodity-based currency. So that's giving a little bit of hope to perhaps we're seeing a low in the resource sector. But we're still looking. We look like maybe the downside is limited on the resource, and if more good news comes out in the different countries, we may see the resource sector turn around and start rising again.
Great quote here, Pam, from our friend John Embry, who says gold and silver are reasserting themselves in their historic role as money. He thinks it's a great time to put some cash into gold and silver shares.
Yes, I think I think selective buying is clearly a good thing to do right now, but selective buying, because you can't just buy any gold mine or any silver mine because they all have been moving very differently.
Pamela, there's a million newsletters out there, and there's some good ones and some bad ones. You guys have been around for 30-plus years. That's a great track record in itself. How can I get involved in the Aden Forecast? Tell me how to subscribe.
Oh, well, thank you. AdenForecast.com. That's our website, and on there you just click us over. In fact, you can tell them that they heard on this interview, and we'll give them a special prize.
Hey, all right.
Yeah, that's how it's a monthly letter with weekly updates.
Sounds good. Don't miss Pamela and Marianne Aden at the World Money Show, April 18th and 19th at the Vancouver Convention Center here in lovely Spring Lake, Vancouver. You can get more information at moneyshow.com. Hey, Pam, it's a pleasure. Thanks for talking to us.
Well, thank you so much. We appreciate it.
After the break, John Kaiser on This Week in Money.
The best of the best. Randy Elvis Frisky and his Las Vegas show band. 40th Anniversary Aloha Tour. This April in Camrose, Edmonton, Red Deer, Drayton Valley, and Lloydminster. On sale now. Details at randyelvisfrisky.com.
This Week in Money is archived online at talkdigitalnetwork.com.
John Kaiser is a mining analyst. He has over 25 years' experience. He runs Kaiser Research Online, and you can find him at kaiserbottomfish.com. John, it's great to have you back on This Week in Money.
Phil, it's wonderful to be back.
Hey, it's been about a year since we talked. You got a fascinating piece on the Kaiser blog, something we should be paying attention to this time of year. Bracing for the extinction of 500 juniors or an entire institution. Please check it out. I want to make sure that you see all the wonderful charts that go along with John's article. A real wake-up call, John, for TSX and TSXV retail investors. Market's basically been turned on its head by what you're calling spiders. Who are these spiders, and what's changed in the way these exchanges work?
Well, we've got two factors working here. One is this large concern out there that we are actually heading into a 30s-style depression or severe global recession, which is going to impact metal demand, and which, of course, will impact prices, which will mean many of these projects that companies are looking for or are working on to demonstrate their feasibility will prove to be not in the money and, in essence, a bust. In this context of muted market interest where institutional money has withdrawn from the sector because they are very much into the resource feasibility demonstration aspect of the junior sector, we also have a situation where retail investor has remained largely absent since the Great Bre-X betrayal in 1997. Coming against the background of all this are new technological changes such as the decision by both the American regulators and the Canadian regulators to allow short selling on a downtick and to allow algorithmic programming to be hooked up to the electronic order books. And so what's emerged is a trading culture which is largely divorced from the fundamentals of a company, but very much stalking volatility and working these markets to suck basically the capital out of it. And this is extremely damaging to the junior resource sector where we're dealing with companies that do not have cash flow, no revenues. They're basically trying to demonstrate that this target is in fact a very valuable deposit once it's been drilled off, or a deposit that they already have is actually feasible to put into production. So there's no real numbers or metrics that the industry can look at to say, well, this company is worth at least this much. It's all based on extrapolations of existing data and projections about future metal prices. And so now this trading culture, they use computer technology to monitor the system, and I call them spiders because it's like a vast web. When you have, trading come into a stock, money come in because some newsletter writer has written something positive, or there's a research report, or even perhaps a news release that's encouraging, they can sense this. They've got their monitoring system there. And I don't think on the Canadian exchange it's so much the computers that do the trading, except in a few isolated instances.
Okay.
But they are used to alert human traders who then scuttle over there and are able to intercept the buy orders that are coming in essence, short sell stock that they do not really own and that they only intend to order. But because they can sell on a downtick when they've exhausted the inflow of new money, they can just lean on the order book and bash things out and create a cascade of selling from the longs who see what looks like a rally and an adjustment to a higher valuation snuffed out once again. And if this sector ever tries to go, gain strength again, this sort of spider trader mentality is going to snuff it out before it can even get going, and that has me worried.
Now, algorithmic trading affects, of course, the big board to a lesser degree, but these are small, fragile companies looking for exploration money. Why are you laying the blame at the feet of the TMX group here? What are they doing to get this going?
The TMX group has a whole range of companies. On the TSX itself, they are substantial companies in the financial sector, in the industrial sector, and also in the mining sector, big producing companies. They also have a number of companies that are more of the junior variety, but most of the junior variety are on the TSX Venture Exchange. And to allow short selling on a downtick basically is very destructive to, I think, they're sort of their golden goose, because they skew the playing field in favor of traders, because it's much easier to make something go down, to break it, than to build it up. And with the emergence of discounted commissions, the brokers who used to serve as important network hubs communicating to investors about what was going on with a company, they are not playing this role anymore. They are now looking just at getting fees on the value of the portfolio. So the less time they actually spend with the customer, the more money they make. So that interface has disappeared, leaving the investors out there to figure stuff out on their own. And because there's also a whole regulatory infrastructure that pretty much forbids companies from monetarily quantifying what it is that they hope to achieve by drilling this target or doing this feasibility work, everybody is on their own to figure out what this is potentially worth. And there's no public repository for posting or filing people's beliefs about what the outcome might be. So when these traders come in there and trash the stock, each person is on his own. And the TSX Venture basically has set things up so that it's a one-sided playing field. And I don't think they're going to change this, because algorithmic trading, high-frequency trading, if they can't sell on a downtick, they will never be in compliance with the old short selling only on an uptick rule. So they're not going to turn the clock back on that. So something else needs to happen to offset this lead blanket that's been laid upon the junior sector.
We're talking to John Kaiser from Kaiser Research Online here on This Week in Money. A bunch of great charts in your article over the blog. One of the most fascinating for me, this chart is showing the juniors themselves. Here's an interesting stat. Since 2005, over 200 Canadian-listed juniors have been taken over, and nearly all of these companies are basically, as you're saying, exploration failures. How's that work?
The last decade, from about 2003 onwards, marked a brand new phase for the junior sector. This was when China's economy really started to come on stream, and demand for raw materials basically exceeded what the mining industry was set up to supply. So we had substantial real increases in the prices of metals. For example, copper going from 60 cents to $4, nickel going from its $2-3 range, trading as high as $25 a pound before settling back molybdenum going from $3 a pound to as high as $35 a pound. And what this implied was that the downtrend in real prices that had characterized the 50-year period after World War II had reversed, and we were in an age of new, higher real prices. So during those past 50 years, there had been lots and lots of exploration done around the world, and deposits were discovered, but the grade wasn't sufficient or the location wasn't right to put these into production. So anything that doesn't go into production is technically a failure, yet it is still an asset that has been created by the risk capital of past exploration cycles. And what happened was when the industry realized that there was a serious change afoot, and the mining companies themselves didn't figure it out until 2006, but the junior resource guys did. So they found all these deposits and got them out of the private sector, put them into public shelves, and then turned to the institutional market and said, hey, when we crunch the numbers in terms of these new super cycle China-driven prices, this stuff is economic. And most of that takeover activity that we saw there was bigger companies absorbing these deposits that the juniors had dragged out of the woodwork and upgraded through resource feasibility demonstration work. And this was phenomenal because the technical expertise that helped this happen really upgraded the talent pool within the junior sector, which in the 80s and 90s was restricted largely to generating targets and drilling them. And if you found something really good, a major swooped in, took it over, and carried it on from there.
This Week in Money is archived online at talkdigitalnetwork.com.
We are talking to John Kaiser on This Week in Money. We have been talking all year long about copper, silver, and gold prices. They're near record levels. Mining stocks, we've been kind of scratching our heads. They're not doing so well and wondering why. You're saying it's caused by something called the mining sector inflation rate. What happens here?
Well, part of the whole sort of China-driven demand for raw materials also increased the price of these raw materials as well as the technical expertise to create the equipment or to put these things into production. And the disturbing thing that's bothered everybody is that since about 2008, 2009, there's been sort of a catch-up inflation in the mine development sector. So capital costs and operating costs are estimated to have increased about 10% annually in the last 4 to 5 years compared to the 2 to 3% CPI that's official for the general inflation index. And so even if you inflation adjust metal prices from, say, 1980 onward, that gives you maybe a price like $3 copper. But if from 2008 on you suddenly add 10% per year, what looked like a real price gain for the metals has actually been gobbled up by the especially high inflation rate for the mining sector. I think this has probably stabilized right now, and going forward, I do not think we'll see the same level of a mining cost escalation. But that has definitely dampened the enthusiasm for the market as they see the feasibility studies come in with much higher capital costs than ever imagined, much higher operating costs. And coupled with this general anxiety that we are heading into a recession, we're going to see lower metal prices, the market has been inclined to discount the prices of these companies by plugging in lower metal prices combined with these higher capital and operating costs, which produces considerably lower valuations than if you were to plug in the actual metal prices that we are seeing these days.
John, speaking of anxiety, we're starting to realize the fiscal cliff is more of what Steve Forbes calls a fiscal pothole. Once we realize that and wake up, you're saying we're going to see a whole lot more merger and acquisition activity in the junior resource space.
Yes. With regards to the fiscal cliff, it's better to describe it as a fiscal slope because it's not like on January 1st anything changes.
Yeah.
What changes is as far as capital gains and the tax that you pay a year and 3 months later in April 2014, that's going to be higher. For payroll taxes and that the people who are just ordinary income earners, they will immediately have $200 or $300 less a month to buy their groceries and so on. But that itself is not going to have a major impact. It's the cutbacks in, say, the defense budget and other services which could have a multiplier effect in the economy, which could put the United States economy into an austerity-driven downturn. And that would be very bad because if this actually did happen, then we would see Europe continue to limp along and have no chance of recovery, and the Chinese slow down stabilization and going forward, that would also be hurt. So it's actually quite critical for the U.S. economy to start trending upwards. I think we'll be surprised. We'll see that the manufacturing renaissance is back on track after the industry spent 18 months sort of holding off so that they could throw the election in favor of the Republican Party. And once we start seeing that the light at the end of the tunnel is no longer shrinking, then there will be this collective acceptance in the mining industry, in the markets, that metal prices are not going down. We're not going into a depression. And when that happens, rather than plugging $1,200 gold into cash flow models, they'll plug in $1,700 gold. They'll plug in $3.50 copper rather than $2 copper. And then there will be a wave of mergers and acquisitions by the big guys, taking out all the best of the advanced companies, of which there's about 400 companies that have advanced pre-production projects. And that wave comes from simply a glass going from half empty to half full. And when it kicks in, I think it'll be quite violent and will catch this market off guard.
John Kaiser's blog post is called Bracing for the Extinction of 500 Juniors or an Entire Institution. It's at KaiserBottomfish.com. John, a great Christmas gift will probably be a trial membership. We need information. Tell me how I can get access to Kaiser Research online.
It's very simple. You do a first-time registration. I recommend people do the $100 trial, which is good for until the end of the first full month. It gives you access to our search engine, which is, I think, very timely right now. Mm-hmm. You can find out which companies have money, which companies have gold deposits, how many shares they have out. And we've also published our bottom fish list in July, anticipating that we would have a little bump in September, which we did, and then a fall off right now in the December period. So we've already flagged just over 100 companies, which we would think would be the survivors, not on that list of 500 companies which have less than $200,000 in their treasury and no real means of raising anything in the current market climate. And then, of course, you also get my commentaries, company-specific commentaries, explaining which ones are my best picks and what needs to happen to make some very substantial scores, especially if I'm right about we're heading into a discovery exploration market where it's back to the Arequipas and the Virginia Golds and the Aurelians, where you make 10, 20, 30 times your money rather than the 100, 200, 300% you might make from speculating on advanced gold projects.
John Kaiser, good to talk. Thank you, sir.
Thank you, Phil.
Thanks to our guests, Ross Clark, Pamela Aden, and John Kaiser. And thank you for listening. I'm Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.